Understanding Qualified Retirement Plans, a comprehensive guide. A qualified retirement plan is a type of employer-sponsored retirement plan that adheres to the standards set forth by the Internal Revenue Code, IRC, and the Employee Retirement Income Security Act, ERISA. These plans offer significant tax advantages for both employees and employers, making them a fundamental component of retirement savings in the U.S. This article delves into the intricacies of qualified retirement plans, including the types of plans available, eligibility requirements, tax benefits, and much more. Key takeaways. Qualified retirement plans are employer-sponsored plans that conform to IRS and U.S. Labor Department regulations. They provide tax benefits such as deductions for contributions and tax deferral on investment growth until funds are withdrawn. The two main types of qualified retirement plans are defined benefit and defined contribution plans. Examples of qualified plans include traditional pensions, 401k plans, and profit-sharing plans. Types of qualified retirement plans. Qualified retirement plans can be divided into two primary categories: defined benefit plans and defined contribution plans. 1. Defined benefit plans. Defined benefit plans guarantee employees a specific amount of benefit upon retirement. The employer is responsible for the investment strategy and assumes the risk to meet the retirement obligations. A traditional pension plan is the most recognized example of a defined benefit plan. Features: guaranteed payouts based on a formula considering salary history and years of service. Employers bear the investment risk and manage the plan's funding. 2. Defined contribution plans. In defined contribution plans, the retirement benefit is based on the contributions made and the performance of the investment options chosen by the employee. Common types include 401k and 403b plans. Features: employees have control over their contributions and investment choices. The investment risk is borne by the employee. Hybrid plans. Some plans, such as cash balance plans, combine elements of defined benefit and defined contribution plans. Employees receive guaranteed benefits expressed as a hypothetical account balance, while employers retain investment risk. Requirements for qualified retirement plans. To be classified as a qualified retirement plan, certain requirements must be met, as laid out by the Internal Revenue Code. Key provisions include: eligibility. Employees must be eligible to join the plan by the age of 21 or after completing 1 year of service. Participation. Once eligible, employees should be allowed to enroll in the plan within a defined timeframe. Vesting. Rules dictate how contributions become vested, affecting employees' rights to their benefits. Employer contributions. There are specific guidelines regarding matching contributions from employers. Employers can customize their plans within these regulatory boundaries, but once established, they must adhere to these rules unless officially amended. Tax benefits of qualified retirement plans. Qualified retirement plans provide notable tax advantages. Employer contributions. Employers can deduct contributions made to qualified plans from their taxable income, subject to certain limits. Employee contributions. Employees can also deduct their contributions, which lowers their taxable income in the contribution year. Contributions are made pre-tax, allowing for tax deferral until funds are withdrawn. Tax-deferred growth. Investments within these accounts grow tax-deferred until withdrawal, making it an effective saving strategy. Roth accounts. Contributions to Roth-type plans offer no upfront tax deductions. However, qualified withdrawals are tax-free after age 59.5 and if the account has been established for more than 5 years. Additionally, employees may also be permitted to take loans from their plans or make penalty-free hardship withdrawals under specific circumstances. Non-qualified retirement plans. In contrast, non-qualified retirement plans do not meet all ERISA requirements and therefore do not provide the same tax advantages. These plans are often designed to incentivize and reward top executives. Federal insurance for qualified plans. Many defined benefit plans are insured by the Pension Benefit Guaranty Corporation, PBGC, which offers protections up to certain limits. It is important to note that defined contribution plans do not have such federal insurance. Taxation of withdrawals. Withdrawals from qualified retirement plans are taxed as ordinary income in the year they are taken. This means they are subject to the individual's income tax rate at that time. However, Roth accounts can provide tax-free withdrawals under the right conditions, offering a significant tax strategy for retirement planning. Conclusion. Qualified retirement plans serve as a crucial savings vehicle for American workers, offering tax advantages and a structured approach to retirement savings. With the ability to choose between defined benefit and defined contribution plans, employees can tailor their retirement strategy to meet individual needs. It's essential for both employers and employees to understand the intricacies of these plans to maximize their benefits and ensure a secure financial future in retirement.